Imagine landing your dream investment banking job and having a $400,000 paycheck coming your way. What do you do with it all? Yep, there's a lot of noise online around banking compensation. You see headline numbers, Wolf of Wall Street memes, and lifestyle content that makes it feel like once you're in banking, you get a penthouse, a sports car, and life's all figured out. But when you actually sit down with someone who's living this job day in and day out, the story is much more grounded. The money is very real, but the way it gets used is intentional, structured, and smart. For this video, I interviewed a friend of mine from Wharton. She's in her late 20s and worked at one of the most prestigious elite boutique investment banks in San Francisco. Today, we're going to be going over something you rarely see explained clearly and in detail: how much investment bankers actually make and how that money is used on a month-to-month basis. And at the end of this video, I'll share 2 important money lessons she wanted me to share with you. Let's first dive straight into the numbers of what my friend made in her first year after MBA as an associate in banking. Because she worked at an elite boutique, her base salary was very high at $250,000, which is already top of street. But in addition, she also received several bonuses, including a $50,000 sign-on bonus, $10,000 relocation bonus, and $65,000 stub bonus, which is a partial bonus you get for joining partway through the year. So given she started in July, she made $250,000 in her first 6 months on the job with all the bonuses. And keep in mind, the first 2-ish months or so are just for training, so she really only worked 4 months for that money, which is pretty damn good. Then starting in the new year, the main change is the year-end bonus, which at her firm can range anywhere from 40 to 80% of base salary. So choosing the midpoint of around 60% leads to around a $150,000 bonus. And so combined with her base salary of $250K, that leaves her at $400,000 in total comp for her first full year as an associate. And the golden handcuffs are officially on, locked, and the keys are thrown away. On top of cash compensation, by the way, bankers also receive expensed dinners if you're in the office past around 7 p.m., which is basically all the time. And then Ubers after 9 p.m. are also paid for, which helps reduce day-to-day expenses. At this point, you may assume that everything in life changes, but the reality is that money doesn't magically solve stress, uncertainty, or long-term career questions. What it really does is give you leverage, and whether that leverage works for you or disappears depends entirely on how you handle your money, which is what we're going to go into next. Real quick though, before moving on, if you're watching this because you're actually trying to break into banking yourself and you want personalized help for recruiting, check out my mentorship program, The Banking Accelerator. You'll get one-on-one coaching, weekly group calls with me, an interview bank with over 500 real questions asked, over 30 Excel exercises for technical prep, a daily finance newsletter, and an active community with 24/7 chat support. If you're interested, book a free call with my team using the link in the description or by scanning the QR code on the screen you see here. With that said, let's get back to the video. So we talked about the money flowing in. Now let's talk about the money flowing out on a month-to-month basis. And this is really where your money habits determine your long-term financial outcome. First, even though my friend received a bunch of bonuses, most of that was put into high-yield savings accounts or investments. And what my friend mainly budgeted for was based on her $250,000 base salary, which leads to pre-tax monthly income of about $21,000 and post-tax of $12,300 for her to freely spend. My friend provided her expenses for 1 month, which was largely representative of how she spends her money. So let's go into her expenses starting from the lowest ones to the highest. Starting with utilities, they were around $76, gym $105, and food $670, with around $290 going towards groceries and $380 to spending eating out at restaurants. And remember that because bankers get a lot of dinners expensed, they save a lot on food costs. Then social expenses, which are things like concerts, gifts, or wedding registries, were around $400, and miscellaneous items for shopping, personal care, and etc. was around $715. Transportation for this particular month was a large expense at around $1,700 due to an international flight she purchased, so normally this amount would either be saved or spent on something else. We now go into the 3 largest monthly expenses, starting with investments, which are split between a high-yield savings account, a personally managed ETF portfolio, and a really small portion into high-risk investments, which all led to around $2,100 a month. Next, her rent is a pretty reasonable $2,200 a month for a studio apartment in San Francisco. And I know some friends spending $3,000 to $4,000 for 1-bedroom apartments, so that's pretty modest in comparison to what she could afford. Last but not least, the largest expense was her MBA student loans, which was around $4,300. And as you can see, her largest three categories, loans, rent, and investments, made up the majority of monthly cash flow, which also reflects where she is in life. Prioritizing debt reduction, keeping housing stable and not excessive, and restarting long-term investing now that she's earning after 2 years of not working in business school. So all in all, her spending really isn't crazy at all, and I'd say it's pretty sensible. I'll say not every banker is super diligent because I've seen a lot of people spend like crazy once you start making money, and it gets harder and harder to live below your means. In relative terms though, my friend was making bank, and I also asked her for 2 money lessons that I could share with all of you, so let's now go into those. The first lesson was to avoid and resist lifestyle creep at all costs, which as you saw is something she actually lived, not just preached. Making $400,000 a year is a lot, but interestingly, my friend's day-to-day life didn't really change much after the income jump. She didn't upgrade to a luxury building, and she prefers hosting dinners at home rather than spending on Michelin star meals. In a career as demanding as banking, the shift towards better apartments, nice cars, and lavish spending can happen really fast. And what starts as optional can become an obligation, especially with the social pressures of seeing your buddies spending carelessly. It makes you think that you should too. Then all of a sudden, one day being able to walk away from a job that makes you unhappy feels a lot harder than it should be. It may sound boring, but the financially smartest people treat money as a tool to buy freedom and flexibility, not validation. And this mindset showed up very clearly in how my friend approached her spending. And from building a strong financial foundation, she was able to gain a lot of peace of mind as well. The second lesson was to keep investing simple, which is ironic because even though my friend worked in finance, rather than trying to optimize every last dollar or chase complexity, she focused on clarity and sustainability. Most of her investing is plain and boring, runs through Vanguard and Fidelity, and is invested in an automatic regular basis. And how she mentally organizes her money is in 3 distinct buckets that each serve a very distinct purpose. The first bucket is the core foundation, long-term buy and hold investing through broad market ETFs. This is the money meant to compound quietly in the background over decades. The second bucket is focused on her parents' retirement. Helping create long-term security for them is a major priority for her, and it reflects a broader view of what money is for, not just maximizing personal net worth, but making sure the people who matter most to you are taken care of. The third bucket is a small portion of high-risk investments, including individual stocks and an angel investment in a restaurant group. This capital is money she doesn't have to rely on, and by making sure it's a small amount, she's able to prevent the risk from becoming stress. I actually really liked the way my friend categorized her investments, and I also invest in a very similar way, very automatic, regular, stress-free, because I realized that all my highest risk investments hardly ever paid off, not worth the stress anyway. And I realized if I just invested without touching my money, I would have been way better off in the long run. So now all of my investments are just purely automatic. So here's the real takeaway. The people who actually win in the long run are not the ones who upgrade their lives the fastest. They're the ones who keep fixed costs stable, invest consistently, manage debt thoughtfully, and use money to buy flexibility rather than validation. To my friend, the biggest benefit of high income wasn't luxury, but optionality. And when you pair that optionality with clarity around what you want from your career and your life, the money starts working for you instead of the other way around. Alright, so that concludes the video, and as a reminder, if you want help breaking into banking to start building your own financial foundation, check out my one-on-one mentorship program, the Banking Accelerator, using the link or by scanning the QR code that you see here with your phone, and you can book a free strategy call with my team. Lastly, if you liked this video, let me know in the comments because I'm thinking about asking my friends in private equity and hedge funds to make a similar video with them. With that said, thank you all so much as always for watching and hope to catch you in the next one.